This episode is brought to you by Persona. In fintech, one bad actor slipping through onboarding can cost you way more than a lost conversion. It can cost you your compliance standing. Persona gives you the identity verification infrastructure to catch fraud early, stay compliant, and still convert legitimate users without building it yourself. Fintech Takes listeners can claim a free year of access at withpersona.com/FTT. Hello, and welcome back to the Fintech Takes podcast. Today, I have another episode of Fintech Recap with the marvelous and mysterious and difficult to pin down Jason Mikula, author of the Fintech Business Weekly newsletter. As we do, Jason came on to recap what's been happening for the last month or so in fintech news, and we picked some fun stories. We started by talking about Bilt, the unicorn credit card company that I personally have been obsessed with for a long time, and that Jason has done some marvelous reporting on more recently, particularly around the transition to what the company calls Bilt 2.0, and why that transition has been a little rockier than I think Bilt was hoping for, and certainly than its customers were hoping for. We talk about that. We talk about what might have been behind it, and really the evolving nature of bank, fintech, and fintech infrastructure relationships, which brings us to our second story that we talked about, which was the evolving competitive dynamics in the banking as a service space. We didn't go back to BaaS Island because there hasn't been a tremendous amount of compliance stuff happening in banking as a service recently. Read into that what you will. But I had a theory that I wanted to bounce off of Jason about banking as a service's growing graduation problem and what that might mean for the space. And if you don't know what that means, just keep listening and you will find out. We end by talking about the state of New York, which has really seized the mantle as the rulemaking authority on all things consumer protection in the void created by the functional death of the CFPB. We talk about New York's new proposed data rights access legislation. We talk a little bit about New York's BNPL regulations, which are rolling out. And more broadly, we just talk about the ongoing fight between state regulators and federal regulators about who gets to regulate different areas of financial services and where consumer protection fits into all of that. Great conversation. Long conversation. And of course, we made time at the end for our typical can't let it goes. There's some stuff that's pissing us off right now. And so we vented our feelings at the very end of the podcast. A delight as always to talk to Jason. And without further ado, here is Fintech Recap. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, well, we are back at it for another month. Jason, great to see you.
Good to see you. You have a, I think, smaller beard than the last time we podcasted, I think.
This is true. I'm sort of
and so do I, actually.
See, so we're getting that. This is like the beginning of summer is how I think about it, right? Like now it's time to like kind of trim it down, have like a sort of hot weather facial hair situation. So no, I'm excited. I actually, to give you a little sneak peek into my travel schedule, when folks hear this, I will, I guess, just be getting done with Fintech Meetup in Las Vegas, and I am going to be the host of a Family Feud style game show session that we are doing, which is the first time I've ever done like a game show themed, event at a conference. And because it's Family Feud, I was wondering if I should even go more short hair bald than I'm doing right now and just do the mustache and kind of go like Steve Harvey is kind of the theme. So I'm debating that. I think my wife might divorce me. That's the downside to that plan. But
I mean, mustaches are apparently very in right now.
They're back. Yeah.
So I don't know if it's a good thing or a bad thing.
I what I've observed is whenever I've messed around with the beard at all, my wife objects tremendously, but random strangers, men usually who I walk by on the street, are like, hell yeah, brother, stay strong. So like maybe I just need to lean into that direction. I don't know. You're not really going to be traveling much. I'm not going to see you in Vegas.
No, so I I had some unexpected adjustments to my schedule, but I will not be in Las Vegas.
You're broken up about that. I can tell.
Once a year, I figure is enough. So I will,
fair.
presumably be there in the fall. But no, I'm going to spend, when this comes out, I will be, I should not say where I am actually, but I will be in Oaxaca, the state in Mexico, and I'm going to spend about a month there, finally, allegedly learning Spanish for real. Doing a language course for about a month or so before I head back to the Netherlands, by which time hopefully it won't be cold and horrible.
Well, that seems like a very, very good way to spend some time. Jason, before we get into fintech stuff, I don't think I've gotten your final end of season review on industry. So I need to ask, because I know you finally caught up, and when we last spoke about it, I think it was like sort of it's normal kind of crazy for that show. The outcome for the intrepid investigative reporter didn't go great. I can't remember if we'd quite gotten to that point in the season, but now you've finished the whole thing, and I mean, it went off the rails. It went completely off the rails.
Yes, it did. I almost added that to the outline, but I was like, I don't know. Do we want to talk about this? And your timing is good, because I watched that by myself, but then my partner also follows the show, so we literally rewatched the last 2 episodes last night.
Nice.
I will say at the beginning, towards the beginning of the season, I believe I described the company, the fictional company Tender, as like Revolut Wirecard. Now that we're done, it's definitely just Wirecard. Wirecard with a dash of Epstein, apparently.
Sure.
Which I like, as we were watching this, my boyfriend was only half paying attention, and I had to like explain the very, very numerous parallels, and spoiler alert for anyone who hasn't finished, etc. Between like the Yasmin character and Ghislaine Maxwell. And he's like, wait, her dad also had a boat? And I'm like, yes. And he named the boat after her? And I'm like, yes. And the dad mysteriously died off the boat? I'm like, yes, it's not subtle. It's very, very clear.
No, that is very true. You would have been explaining those things to me too, because I think I was short some of those details, but even lacking some of those details, they weren't subtle in drawing the parallel. And as always, life imitates art, art imitates life. I'm a little scared to find out what's happening on the next season of Industry, but I guess we'll just have to wait until we see.
I mean, I don't know if I'm actually hoping for this or if I'm joking, but they need to have like whatever a knockoff version of Erebor is. And then like that is like the plot line of Industry's season, whatever it is, 5, 6.
The idea of like really like these sort of like overly aggro, like defense contractor tech bro kind of combining with banking and finance, that would be a good angle to take. There could be autonomous killer robots created by like a different founder who comes from sort of a failed background. Like there's a lot to work with.
I mean, they'll need to ship us like complimentary blood pressure medication as like a promotion for the next season. So HBO, if you're listening, you know where to find us.
Yes, and we are more than happy to do a more dedicated review segment to Industry if you'd like to sponsor us for next season. Jason, we have plenty of real life fintech drama to get to. The first story is yours. I will let you cook.
Yeah, so this is from a couple of weeks ago at this point, but it was, I mean, a pretty big story. So I feel like, and is very much in the wheelhouse of what you and I like to talk about. Bilt,
yes.
I will admit, this is one of those companies that is relatively, like looms relatively large in the fintech industry for good reason. I mean, it grew very quickly, landed a very high-profile partnership with Wells Fargo, which subsequently went awry. So, I mean, it is justified that it kind of like takes up a lot of space in the fintech banking news cycle and imagination. But I'll admit, like, I haven't actually paid super close attention to it. And the high-level understanding or the sort of pieces that were most prominent in how I thought about it was thinking about it specifically as a credit card company,
Sure.
getting points for paying your rent. Although apparently even before the sort of relaunch as Bilt 2.0, as the company has dubbed it, Bilt really tried to position itself as a neighborhood loyalty and rewards ecosystem, first and foremost, not necessarily specifically a credit card first and foremost, with sort of this ecosystem of loyalty and rewards being anchored around where somebody lives, where you pay your rent, and now with the new iteration where you pay your mortgage. As I'm sure anyone listening to you or me is well aware, you typically cannot pay your rent or mortgage with a card payment because the cost of merchants to accept a card payment is typically around 2 to 3% versus, ACH or GASP, a paper check, which typically is going to incur no fee for the merchant, or in this case, the landlord. The sort of alchemy, and I do think alchemy is the right word, that Bilt performed in order to let users earn rewards was this partnership that Bilt had struck with Wells Fargo.
Yeah.
Fun side quest that we do not need to go down. Bilt's first bank partner was, drumroll, Evolve Bank and Trust.
Of course. Of
Go
course.
figure.
Of course.
But ultimately, Wells Fargo took on this partnership, and their studious analysts, I'm sure, toiled away, making a very pretty looking deck and business case that was just chock full of assumptions that turned out to be totally, completely wrong, including how much cardholders would spend apart from their rent, what share of users would actually revolve on the card, what share of users they could eventually convert into getting a mortgage or other products with Wells Fargo. Wall Street Journal did a very good piece, or actually multiple pieces covering this. So if people want to know that whole backstory, they should go read it. But ultimately, the upshot was Wells Fargo is losing something in the order of $10 million per month on this partnership. And despite the contract running through 2029, Wells Fargo decided to pull the plug and announce that in July 2025. So Bilt, wanting to have a business, needed to find not only a new bank partner, but also a processor and somebody to provide the debt to do the lending on this card. So welcome Bilt 2.0, as the company christened the new iteration. Bank partner, Column, issuer processor, Cardless. Cardless does other stuff in the co-brand space, not particularly big from what I understand compared to some of the more major players in the issuer processor space.
Yeah, it was a big win for Cardless, right? Relative to, I think, partners they'd had before. Yeah.
And capital provider, which I'll also admit I've not heard of this firm, Fidem Financial, as well as other debt capital providers. So as anyone who's been even tangentially involved in doing a live card program migration knows, these are incredibly complicated, take months, if not over a year of planning, execution, and credit card programs tend to be orders of magnitude more complicated than debit for a host of reasons.
Mm-hmm.
I mean, outstanding balances, dealing with refunds, the consumer protections under TILA and under Card Act are more significant than what users would have under a debit program. So long story short, Bilt's migration to Bilt 2.0 was not exactly the seamless transition that it promised users, using the word seamless. Cardholders complained about a whole host of things, that they were declined for the new card when they applied for it. They received credit limits substantially lower than what they held at Wells Fargo. That the new reward structure, both on the earning side and the redemption side, was excessively complicated. Transactions that were frozen, declined, users experiencing fraud, whole host of things. I will not list all of them because there was a lot. But I mean, I think the most important and most, I think for users, sort of distressing issue was cardholders who had rent or mortgage payments either not made, that were delayed, that were bounced, that were double debited out of their linked external linked bank account or checking account, really causing like a lot of problems. I mean, if you scroll through Reddit or scroll through Twitter, I mean, people were, I would argue, justifiably like very upset that they were experiencing this issue. One last thing before I get your input, get your take on this. I think it's important to call out that how Bilt actually handles users' rent and now mortgage payments has changed very significantly versus its prior iteration.
I wanted to ask you about that, yeah, because the mechanics are not like, hey, you just pay it with a credit card. Like, that's not how it works.
Well, and I actually had a Bilt 1.0 card that I literally did not use a single time, but I signed up for it. Under the Wells Fargo program. I did not migrate to the new program because I was just too lazy to sign up for another credit card. But previously, for Bilt card holders, their rent was paid against the credit line. So it was actually a transaction on the credit card that they were carrying as a balance that they could choose to basically pay off right away. So before their statement cycle happened, if they wanted to say, hey, I charge my whatever, $2,000 of rent, and then 2 days later, I'm going to make a $2,000 payment against my credit line, they could do that. They could also make multiple payments over the course of the month. So functionally a kind of BNPL for rent sort of built into the card. Or they could just wait for the regular statement cycle to close and then make a full payment. And that is a capability that some users apparently really liked and were upset that it went away. The ability to sort of split their rent into, multiple payments over the course of a month, presumably in many cases to align with what their pay cycle was.
Well, and just to pause on that for a second, like Bilt, the card that rewards you for paying your rent, it would make sense logically that is in fact a card that you can use to pay rent. And if it's a credit card, it's a card you can use to pay rent while floating the repayments in various ways. So that everything you just described seems very like obviously a value proposition of, I think, how Bilt positioned itself originally, which was credit card for paying your rent.
Yeah, exactly. So the new structure, and I'm sure that there were all sorts of communications that went out about this. But again, as a card program, as the sponsoring bank, as the issuer, it's like, I haven't quite done this type of transition, but like generally you should probably build your transition plan expecting that people are not going to read what you send them, because people get zillions of emails, most of which are garbage marketing emails and spam. And so like, yes, you wish that consumers would read all communications you send them, but it's probably best to build the process in such a way that you assume that they have not read that stuff.
Yeah, especially when you're making a big change. So in this case, the change was what?
So in the 2.0 cycle, users no longer have the option to float their housing payment on their credit line. This is, I mean, it's convoluted because there are a lot of different methods by which a user can choose to pay. But some of the more common ones within Bilt are either ACH. So basically, Bilt would be debiting your external bank account for that rent or mortgage payment, which according to Bilt's terms and conditions, at least as of the time that I reviewed them, would go into what Bilt calls a payment account that Bilt would set up for the benefit of its users.
I just like a shadow just passed over my window as you said that. It was really weird.
With the two banks listed in Bilt's T's and C's being Column and Evolve, it's not clear
There's
to what
that
extent,
shadow again. Weird.
It's not clear to what extent Bilt is really actively still using Evolve versus just failing to keep their terms and conditions like accurate and up to date. But at the time I reviewed it for the piece I wrote, it listed Evolve essentially like co-equally to Column. And then Bilt would disperse the rent or mortgage payment from that account, which again, depending on the method, that could be the like the landlord's whatever servicer or the landlord portal debiting that FBO account, or it could be Bilt cutting and mailing a physical check on behalf of the end user.
Maybe depending on the arrangement that the landlord has with Bilt on the property management side.
Yeah, and the mortgage servicer side as well. Yes,
right. Got it. Okay.
So I mean, I recall reading one very angry user who their post was something to the effect of the check that Bilt sent was returned from, I forget if it's the landlord or the mortgage servicer, because the underlying account was overdrawn. Which, I mean, if your FBO account holding everyone's housing payments is overdrawn, I'm very nervous. But I mean, a last caveat on this, and then I promise I'll let you talk. Something I found very interesting is that kind of like regardless of how a user was actually paying, so whether it was this ACH method I described, or it's also possible to pay via Venmo if your landlord accepts Venmo, where the Venmo is then linked through your Bilt credit card. But Bilt is saying none of these are going on the credit line, and we will automatically debit your linked bank account essentially like next business day or within a couple of business days. The way it's presented on statements that I've seen makes it's undifferentiated from any other transaction on that card. So it'll be like, okay, you went to Walmart, you went to Shell for gasoline, you had a housing payment, negative $2,000 debit, and then automatically, with like apparently no ability to stop or control this, Bilt would then debit your external bank account within a day or two to repay that housing payment.
So no floating anymore.
Yeah. Me being me, my head immediately goes to like, well, what about the Card Act and requirements around billing cycles? What about TILA? What about possible EFTA issues? So my first question to you, because there's plenty we could talk about here, how is it possible that Bilt and its partners botched the transition this badly? And I mean, obviously we can't know everything, or frankly, most of what happened as external observers, but sort of who bears what responsibility here, given the number of different partners and sort of service providers involved?
Really wonderful question and great summary. I think we had actually talked about Bilt in an earlier episode like last year, but it was like the premise of our discussion was like, do you understand Bilt? No, I don't understand it either. Like I remember having a version of this conversation with you a while back, and I've always felt the same way. I mean, I think the biggest thing that I sort of notice with this is that Bilt has gone from a really straightforward model that didn't make sort of sense from a unit economic perspective, but did make sense operationally, to a model that makes more sense, I would presume, from a unit economics perspective, but has become really ridiculously complicated from an operational perspective. So to break that down, I would think about it as, okay, we Bilt have convinced Wells Fargo to sign up for this horrifically bad deal where they will agree to cover the interchange costs for landlords who are accepting this form of payment to pay the rent. We will also, it sounds like, be using Wells Fargo to provide the credit facility backing those loans that are made. That will then give the customer the ability to float that credit as much or as little as they want to for that payment, just like you can with any credit card. And we will encourage Wells Fargo to be very aggressive in approving customers for accounts, for approving them for large credit lines, and for trying to grow this based on the invalid assumptions it turns out that Wells Fargo made about the success of the card and how it would be used. And by doing that, they were then able to go, my understanding is, to landlords who were like, I'm not accepting a credit card. That's insane. Like, you can't pay with a credit card, and convince them to accept the credit card because Wells was going to eat the cost. But it was the landlord accepting credit card as a form of payment. So everything was like very vertically integrated. It was very straightforward operationally. And the cost of it was just that Wells Fargo made a really bad deal and was getting screwed on the economics. And my understanding, reading the Wall Street Journal reporting on the breakup between Wells Fargo and Bilt, was that Wells Fargo basically went to Bilt and said, look, we can't get out of this deal for another couple of years, but we do have the ability, and then I think a similar thing happened with Goldman Sachs and Apple, we do have the ability to basically tighten the credit box to the point where we can make it like miserable for you. So you should just agree to exit this partnership early. And that's what happened. So you go from that to this new reality and Bilt 2.0. And in Bilt 2.0, Bilt basically had to solve a set of problems, right? Problem number one is all of our existing users signed up for this great value proposition. Like, I can't believe this. This is too good to be true. This is amazing. I love this. Doesn't necessarily mean they're going to use it as their primary card, but they are going to use it to pay their rent, get rewards, and use it like a credit card in that sort of operational capacity. So we have to make it seem like Bilt 2.0 is as good or better than what they were getting from Bilt 1.0. Normally, when you go from 1.0 to 2.0, that's like an evolutionary upgrade. That's typically the way you sort of think about these things. So we have to sort of maintain the illusion of the value proposition being really strong for customers. However, and this is just my guess, we can't get anyone to eat the costs that Wells was eating before, right? Column's not going to do it. Cardless isn't going to do it. We're probably not going to get the same great terms we had before from a credit line perspective and a credit facility perspective. So we have to make this make more sense for our partners. And part of that, and I wrote about this in my newsletter, was we're going to change the deal with cardholders. And that was kind of the known part of the problem with the rollout of Bilt 2.0 was card users were, I think, frustrated, but maybe also like kind of understood where Bilt was coming from. When Bilt changed the rules for eligibility with rewards, and you're not going to get the same, like, I can't remember what they used to call it, but I think it was like bananas, right? Where it's like you can put 7 transactions of any size on the Bilt card, and that qualifies you for the full rewards that you get for paying rent on the card. That was kind of the loophole that all the smart users were exploiting. Bilt got rid of that. They made it so you have to spend a certain, I think, percentage of your housing payment on the card in non-housing spend in order to unlock all the rewards. So part of it was we have to solve the unit economic problem we have with this benefit that we offer. However, I think the other part that I didn't appreciate before your reporting on all of this and all of these user complaints was they also had to make it work differently from an operational perspective. And so now the premise is, hey, you can pay your rent or your mortgage with any landlord or mortgage servicer, doesn't matter who it is, and we'll facilitate the payment on the back end. And what that means is they don't have to go to all of those individual landlords and mortgage servicers and convince them to accept a credit card as a payment. Like, so that's why they're mailing checks. That's why they're facilitating Venmo transactions, why there's draws on an FBO account. They had to create more complexity in the background to integrate with all the different servicers and landlords that they wanted to integrate with. And at the same time, they had to make it work less like a credit card, right? So now it either goes on your credit line, it sounds like, briefly, and then they immediately repay themselves, or it just doesn't ever go on your credit line, but it gets counted if it's linked to your Bilt account for the purposes of earning rewards. And that also kind of undercuts and makes more complex the very simple value proposition that used to exist of, this is a card, I'm putting this payment on a card, and I can treat it like any other card transaction. So I guess, Jason, to answer your question, it seems as though in having to move from Bilt 1.0, where Wells Fargo was the loser, to Bilt 2.0, where no single counterparty could be convinced to take like the loss, they made the value proposition worse for those sort of power users that loved Bilt originally. And they moved to like an operational structure where it sounds hacked together. Like, you'll do this and we'll move this into this account and then we'll move this over there. And oh yeah, there's these requirements for the Card Act, but this is how we'll get around it. Like, I can't imagine how much money they spend on lawyers, and maybe they should have spent even more than they did potentially. But like, this sounds like a very complex thing to hack together. And I think that's probably where a lot of the problems came from. Now, you outlined a whole bunch of other things like, I can't pay off my balance at Wells, these other things. That to me strikes me more as like just the operational headache that goes with a sloppily done transfer from one program to another. But on top of those problems, these sort of like, how do the payments work? And like, how is the card credit line debited? Like, those things I think are more a function of we had to break the very clean product operational model we had in order to make the unit economics work for all of our partners. Does that theory make sense to you?
No, I mean that entirely makes sense to me. And as you were talking through that, I mean, something that occurred to me is like the banana thing specifically, which I did see references to bananas when I was like working on this, and like it lacking context, it like wasn't immediately clear like what this was about. But my intuition was along the lines of how you've described it.
Yeah. I can buy 7 individual bananas and I qualify for blah, blah, blah. Yeah.
The point is, Bilt 1.0 built a product that was targeted towards upper income points maximizers. And with this like 2.0 version, I mean, one, just the overall complexity of like, what are the hurdles I have to jump through to earn points? There's some further complexity around like, do you want like Bilt Cash or do you want this other thing that I frankly didn't even read about because I wasn't that interested? So like the complexity has gone up fairly significantly as far as like, what are the requirements you need to meet in order to, earn points on this thing that was the original value prop, your rent or your housing payment. And I suppose like implicitly, the value of those points seems like it's probably has been devalued or is likely to be devalued.
It definitely has, I think. Like, I think all the analysis I've seen is like, there's a way in certain circumstances to use this card where you're going to get roughly the same value, but it requires a great deal more from the user. And for the vast majority of users, use cases, housing payment amounts, all that kind of stuff, the value prop got slightly worse to much worse, is my understanding.
Well, and if the audience you've built that you're trying to migrate is a sort of like hardcore points maxi person, and now you're trying to move them to this other product that is like, well, it's kind of like what it was before, but if that is their mentality, and I think you and I both happen to know somebody who is a hardcore points maxi, they're going to do the math and say, does this actually make sense? Particularly, I didn't even mention this. Under the new setup, there are 3 tiers of cards, the top one of which carries a $495 AMF. And so now if you're that points maxi person running your crazy spreadsheet, you're looking at like, well, does it make sense for me to pay this AMF, get this card, put my rent on it, but I also then need to put, this much other spend in order to get these points versus just doing that spend somewhere else on your Amex Platinum, on your Chase Sapphire, on, whatever card. I'm not, I assume that not every Bilt user is a hardcore Excel like maximizer, but then for those people, you took what was a relatively simple value proposition and have just made it like mind-numbingly complex. I mean, and I think we've discussed this, at least on the group chat, I am not a points maximizer. I do not have enough time in my life to want to spend it thinking about that. And so it's like, I have to imagine there's a segment of Bilt user on the 1.0 product who like sees this new complexity and is just like, yeah, I don't want that. I'm just going to go get a cashback card.
Yeah. I think that's right. I mean, I think basically what we're kind of saying here is that there's an inverse relationship between like value and complexity, right? And I think the magic of Bilt 1.0 was that they were able to offer something that was highly valuable and very simple and straightforward because they got Wells Fargo to foot the bill. But once the game was up with Wells, what was it, $10 million a month that they were losing on Bilt, that was reported by the Wall Street Journal. Like, once it became clear that that was not sustainable, it forced Bilt into the same conundrum, quite frankly, that I think everyone else goes through when they're building a credit card, which is, how much do we want to try to create a thing that's really valuable, but the game you have to play to extract the value from it is incredibly complex, versus lowering the value and simplifying the way that it uses. That's basically the teeter-totter, I think, that exists in the credit card space from a product design perspective. And obviously, if you have massive scale like a Chase, you play that teeter-totter game a little bit differently than if you're a fintech startup or a small bank. But fundamentally, like, the trade-off is complexity and value. And you have to kind of move those two things. And I think where Bilt screwed up, and I kind of wish fintech companies, and I think it would actually be in their best interest sometimes to do this. I wish they'd just be honest sometimes a little bit with their users and go, look, this is what happened. We are long-term trying to build, and this is how Bilt talks about their vision, which I actually kind of find compelling. We want to build neighborhood networks where you live rewards you and all of the merchants that you are sort of in your community. That's what we want to build long-term. What has happened is going to require us to change the product in these ways. If that's not for you, we totally understand. If it is, just stay with us because the product's going to get better and better as we continue to grow in that direction. And instead of saying that, they came out the way I think most entrepreneurs and startups and private companies do, which was, this is Bilt 2.0. It's bigger, it's better. There's 3 cards instead of 1. There's all these new rewards and options. But that was really window dressing on a more complex and less valuable value proposition. And that's just a hard thing to sell, even if the transition from 1.0 to 2.0 goes extraordinarily well, which in this case, obviously, as you've reported, it did not. And so, I don't know, Jason, I mean, what do you think the long-term effect for Bilt is going to be? Because the other thing I've been sort of a little flummoxed by is Bilt had this amazing start to its business because of these great initial partnerships that it structured and these deals it was able to get. I've written about the fact that the CEO, Ankur Jain, is uniquely able to negotiate these types of things based on his own personal network. And so it's not something that's always replicable by other fintech companies. But now that Bilt is sort of slammed into reality, like, how bad is this for the future trajectory of Bilt as a brand, expanding into other products, growing? Like, what's your take on that?
So the neighborhood stuff that you were mentioning, I forget what this was called. When you were growing up or in high school, did your school do fundraisers by selling these like essentially coupon books for like local businesses? It literally reminds me of that. I want to say it's called like the entertainment book or something like that. The neighborhood piece I find interesting, but also have to imagine it's immensely challenging, right? So, I mean, some of what Bilt has described or is currently describing is like, oh, we want to have this like AI-powered neighborhood concierge that like you can just text. Don't be like, oh, you know, you like Italian food, you should go to this restaurant. We'll get you a table and then we'll automatically book your car home after. I mean, one, when you start to get into that, and I guess they're not explicitly positioning it as discounting versus rewards, although in my mind those two things are quite closely linked.
It's like two different ways of saying the same thing, right? Someone's losing money in order to get business, essentially.
And it almost, in addition to the entertainment coupon book, reminds me a little bit of Groupon, because like what is the promise that if you're Bilt and you're Anchor, the CEO, founder of Bilt, like what is the promise you're making to these merchants? Presumably it's about customer retention, customer lifetime value, or, you know, and or foot traffic. And I mean, obviously, you know, Groupon had its heyday, still technically exists. But I mean, fundamentally, it was literally a coupon business.
It was.
And so I really wonder about the ability to successfully scale and sustain this sort of like neighborhood loyalty / discount play, particularly when you are implicitly competing with a bunch of other vendors. Companies like Toast or Square that offer built-in loyalty programs as part of their like point of sale / card acceptance things. So I think it's a bit of an uphill battle from a concept standpoint. And we haven't touched on this, so we can have this be our capstone on this topic. You also need to be able to execute. And everything consumers said about the AI, and this was in the context of AI customer service for the card, can only be described as scathing. I guess I don't think I realized that frontline customer service prior to the transition must have been handled primarily by Wells Fargo, because Bilt seems to have been entirely unprepared to deal with this. And rather than actually hiring staff, their answer seems to have been, we're just going to throw ChatGPT at it and hope for the best. And again, based on like numerous horror stories of just like endless loops in this AI bot, the AI bot giving wrong answers, trying to reach a human. You can't actually call anybody. The phone
There's no
number
number.
that people listed is either Column's phone number or Cardless's phone number. And like whoever they end up reaching there was like able to provide very little or no information.
Sure.
Bilt itself was only available via email. And there were people who were like, I waited 7 days, I waited 10 days, I waited 14 days. And we have seen those kind of customer service availability problems result in like UDAP style complaints in the past. So I mean, the idea that Bilt can sort of keep all of these plates spinning, with its merchants, with its, making sure the economics are working for the debt capital provider, making sure, its bank partner Column is not getting into regulatory trouble for the zillions of problems users are having. Like, based on how things have been going, like, I'm a bit skeptical that all of these, that Humpty Dumpty can be put back together. I crack myself up all the time, clearly. I mean, I should add, I did have a couple of conversations with Bilt's comms team. They did emphasize, and I need to make sure I'm respecting the press comms relationship, but that, it was a relatively small number of people, that, Bilt was doing everything it can to make things right, et cetera, et cetera. I mean, it like the piece to the point that you made, or that we both made, that made this work originally, which was Wells Fargo subsidizing the losses, that piece is gone. And like trying to put all of this stuff back together and have it work at scale seems like an immense uphill battle.
Yeah, I mean, it's almost as if like the thing that got all the press attention with the Wells partnership, including from me when I was writing about it, was the economics of the deal that Wells signed up with and how much money they were losing. But I think the thing I didn't really appreciate until seeing all of this is that like Wells was just incredibly solid, useful, reliable, vertically integrated infrastructure for Bilt to layer its value proposition on top. Like you can criticize the value proposition itself, like doesn't make any sense. How are they making any money? Who's losing money in this deal? Blah, blah, blah. We found out the answer to that. But I think the thing we didn't appreciate was, regardless of the value proposition, turns out having a large bank that does everything and has a customer service staff and has credit lines that they can make available and everything, like a one-stop shop partner is a really nice thing to have. They absorb a lot of the problems and a lot of the stress and a lot of the volume issues that you would otherwise run into. And, the modern story of fintech is sort of either work with a large bank partner like that and hopefully convince them to take a bad deal, or alternatively, duct tape your own solution together by going to lots of different providers, right? And Column will be the bank partner, but they don't have an issuing platform. So you have to go find an issuer processor, and the issuer processor and the partner bank don't want to provide the credit for the credit facility. So we have to go get that from someone else. Like duct taping something together, even under the best of circumstances, doesn't tend to work well. And I think I share your pessimism that at least in the short term, it feels like Bilt is going to be digging itself out of this hole more than like building the next version of the business. So long term, we'll see. But yeah, short to medium term, I wouldn't say I'm super optimistic.
We will have to check back in on where they are in, I don't know, 6 or 12 months. But do you have another non-Bilt related topic for us?
I do. It's not unrelated to what we've been talking about, which is what I'm sort of thinking of as like the graduation problem in banking as a service. And, you know a bit about banking as a service. You wrote a book about it, I think, actually, if I'm remembering right. Can be found on Amazon still. Highly recommend. And I think you talked about this. I've talked about this in the past with banking as a service. It has a graduation problem, which is to say that banking as a service banks will oftentimes work with smaller or newer fintech companies when they first need a bank charter. They will evaluate that company, its risks, its potential for profitability, its expected growth rate, the level of investments that it's taken, on and on and on. And it will basically place a set of bets about who it wants to partner with the hope that those partners can scale and grow into larger, more profitable, less risky partners, customers really, over time. And that's where the banking as a service bank or platform will make its money, right? We'll lose a little bit in the short term as we're bringing new partners on, but as they scale up, that's where we'll sort of pay this investment back. And then much like software as a service, like our fixed costs will all be sort of in for the most part, and we'll have some incremental costs, but we'll get a lot more volume and a lot more profit. And that's kind of the general idea with banking as a service. The challenge is, what happens if those partners get so big and profitable and sophisticated and scaled up that they decide they're going to vertically integrate the piece that you provide and stop working with you? We've seen a lot of this recently, right? Obviously, we've seen a bunch of fintech and crypto companies announce that they are pursuing or have received various types of bank charters. Some of these are state bank charters, industrial loan companies. Some of them are national bank charters issued by the OCC. Some of them are national trust bank charters, Jason, which you've written about. That seems to be a popular answer in the crypto stablecoin area. But in all of those cases, whether it's Mercury, Affirm, PayPal, Coinbase, Nubank, name your fintech or crypto company, they are all in the process, as they get these bank charters or pursue these bank charters, of at least moving in the direction of getting off of their existing bank partners. And this spans the gamut, right? You could have, if you're a lender, a bank partner that really just originates your loans. And it's a very asset-light business model. You originate it, you hold it for maybe a little bit of time, and then your partner sells it off and you just collect the fee income. That's a very popular banking as a service business model, particularly for banks in Utah. It could be kind of the classic way that I think you and I oftentimes talk about banking as a service, which is a deposit-based business, funds held in an FBO account with a subledger that hopefully is keeping track of all of the money. It could be a correspondent or BIN sponsor relationship where we're just working with you to get access to the card networks or get access to sort of other payment rails that the Fed won't let us have directly. But in all of those cases, if they move away and get a bank partner, that bank partner is kind of screwed. And I think this is maybe a story that's been a little under-discussed, as we've seen this explosion in regulators encouraging and welcoming all of these new charters and granting a lot of these new charters. Upstart is the one that I wanted to just dig into for a second because they're the most interesting in some ways. Upstart is a sort of digital lending business that acquires customers, underwrites and originates customers, does so with bank partners, and then will sell those loans that they have originated kind of to the individual bank partners that are part of their network, right? So it's a version of banking as a service, but the way that they've talked about their model is almost more of like, we want to be the digital lending and acquisition infrastructure for community banks. We want to help community banks. And so like in 2019, the company wrote that it was going to be maximizing its impact, not by becoming a new age bank, but by powering banks looking to thrive, and said that powered by upstarts, which was their sort of model, will let banks enforce their own credit policy and lending terms while using upstarts risk models and automation. The company reinforced this message when it went public in 2021, describing itself as a platform that connects borrowers' demand to our network of upstart AI-enabled bank partners. Jason, I mean, that pitch is, in my mind, basically telling community banks, hey, instead of going and building your own digital lending infrastructure and trying to compete directly, don't worry about all that. Don't worry about all this fintech stuff. We'll just go do that for you, and we'll just bring loans to you. Don't worry about it. And I think versions of that story have been playing out in a lot of different areas of banking as a service, where it's like, hey, should we compete with fintech? Should we try to up our game in terms of our product, our technology, our distribution strategy? Or should we just push this easy button, which is banking as a service, get a bunch of partners, hope we get some that grow really big and become profitable, and also just hope that the assumption that's existed in the market for a long time, which is, there's no new de novo charters. Regulators won't give fintech companies charters. This is insane. Hope that assumption holds. And I think what we've seen over the last year is that assumption is now gone. The FDIC, the OCC, the Fed, they're all very comfortable bringing new banks into the regulatory perimeter. And as a result, I think it's made banking as a service and its various models much less appealing, and kind of points out the sort of inherent flaw in this model. I mean, we were just talking about, Column, because they're the partner for Bilt. In addition to the headache that Bilt has undoubtedly caused for them, I mean, Column is at some point going to lose at least a large chunk of the business that they had with Mercury. Another example, which I haven't even brought up yet, is we're seeing an increasing, I think, number of acquisitions of large scaled up fintech companies by banks. Capital One just bought Brex. Guess who Brex used as their bank partner? It was Column, right? So like even someone as sophisticated, both from a technical standpoint and from a go-to-market and sort of customer success standpoint as Column is, they're not immune from this. And in fact, in some ways, they're worse off because they're the ones who have a really great track record and ability to attract the best founders and to get the best programs. Those programs will migrate off. And so I guess my question to you as the knower of all things banking as a service, what do you think about this sort of flaw in the banking as a service model, and how do you think about this problem?
No, I mean, you're absolutely right that this graduation problem, in a sense, has always existed. Yep. The dynamics have changed, right? So the way that I think you and I would have talked about a graduation problem, whatever, before the start of the current administration the charters for everybody, was a graduation from a BaaS platform like a Synctera or a Treasury Prime or a Unit to a, I'm cringing saying this and making air quotes, to a direct bank relationship.
Yes.
Right. So in that scenario, it's like, okay, well, it's easier and faster and cheaper to get my product to market by working with a middleware platform. But when I hit a certain scale, the economics are presumably going to be better, and I want to have a direct line of communication with my bank partner. And that we absolutely saw like cycles of that happen to players in that space, which I think is like not surprising. What has changed, which you point out, is like that model, or sort of the idea that like if I think neobanks provide a very easy example, like I'm kind of handcuffed to my bank partner because the prospect of anybody getting a de novo charter, particularly given just what a disaster, some of the de novo charters in that space, Cough, Vero, have been. It's like, well, there is no other path. So, to use that as an example, if I am Chime and I have relationships with Bancorp and Stride, and I look at sort of the best counterexample, Vero getting a charter, it's like, well, one, I probably can't even do that if I want to. And two, it doesn't really look appealing based on how Vero executed on it. Not to say that Chime couldn't execute on it differently. But you're right. Now that the de novo window, whatever we're calling it, has been thrown wide open, it's like, oh, well, now there are other strategic avenues available, and I'm not limited as a non-bank, whether it's a lender, whether it's a neobank, I'm not limited to this path of only working through a bank partnership. I do think it's, as you're talking, it's like, I'm laughing because it's like, okay, fundamentally, what do these non-bank fintechs represent? I mean, it was like an unbundling of the banking value chain, or I think Dan Ari characterized it as an inversion of the bank value chain in his recent paper that I still haven't read, that I'm going to. But what do we see now as some of these players either apply to charter banks, so to become banks or to form banks, or to your point, in the opposite direction, things like Cap One acquiring Brex. We're seeing a rebundling of some of these capabilities. If I think about like some of the things that attracted banks to play in this partner space, I always think of the Andreessen Horowitz blog post, The Partner Bank Boom, which had this graph, which I've remade multiple times, which plotted some of the banks they put on there were weird. Like they put Comenity on there, which like I wouldn't necessarily consider a BaaS bank, but whatever. Plotted the return on equity versus return on assets on an access, those percentages on an axis. And like, if you look at how banks that we consider, BaaS banks or partner banks compared to sort of vanilla community banks, they wildly outperform on an ROE or ROA basis. So you can see why banks were attracted to come into that space. And we saw a flood of banks newly enter the partner banking space in that crazy 2019 to 2022 window before Blue Ridge got its first consent order. Conversely, in that same time, we had fintechs, and I don't mean to pick on Chime, but like Chime made this point over and over again with Chris Britt characterizing the company as a technology company and really forcefully saying, we're never going to be a bank. Yeah. We don't want to be a bank.
Yep.
And the sort of
we don't want to be valued as a bank. Yeah.
Yes, exactly. Mm-hmm. And the sort of underlying analyst logic, which I'm sure I've said myself many times, is like banks tend to be valued based on a price to book multiple. And particularly if you're a VC-backed startup looking to raise more funding or looking to IPO, you don't want to be valued on price to book. You want to be valued on like fun imaginary metrics like number of monthly active users or price to revenue in a lending business where price to revenue makes no sense and is a terrible thing to look at.
Magic software metrics. Yeah.
So I think the reopening of the charter window and accelerating M&A activity to pull in like the Cap One Brex piece and other deals that look like that, I think it really has scrambled the sort of like the strategic map of like what is happening in this space in a way that I think I haven't really heard discussed extensively.
No. Yeah, I mean, I just kind of was putting the pieces together in my own head because you see these individual things, right? You're like, oh, Mercury's getting a bank charter. That's interesting. Brex was just acquired. That's interesting. And it wasn't until I saw the Upstart news because they had been so sort of assertive in their messaging around, this isn't just banking as a service. This is like, we're going to save community banks. And it didn't quite go that far, but like that was sort of the underlying implication. And it just sort of like struck me that, and I think it kind of ties back to this idea that if you're in this space, you need to have a plan, right? You can't just be like, oh, we're going to pick BaaS because of that chart that A16Z put out. And like, we want an ROE just like that. That looks great. We'll do that. We'll sign up for that too. And I think the reality is I'm not worried about banks that have really figured out banking as a service. I'll use like Bancorp as an example. Like they've been through it for many, many years. They were very early to the market before banking as a service was really a thing. They had their scar tissue based on consent orders and trouble they've gotten into with regulators. But one of the things that banks that really understand this space well, I think about is, all right, are we trying to acquire partners who will just pay us money for not really doing anything and just hope that those partners never go away? And I think that's the bad model in banking as a service and the one that only works as long as regulators keep that de novo window closed. Or alternatively, do we think about BaaS as basically a way to like generate raw materials that we can use to build a great business? And like, I think there are other banking as a service banks where they use fintech as a way to gather low-cost deposits. But the way they make money is not the fees associated with the programs that they run. It's using those deposits to fund really interesting, niche, profitable lending opportunities that they alone have really cracked the code on how to reach. And that's a much less lazy approach to banking as a service because you have to go build that really great lending business. And then banking as a service is just an input, a low cost into this profitable business that you've constructed for yourself that is much more durable. And in that model, I can imagine a scenario where like there are probably some BaaS banks that do that where they're like, look, we don't care about the graduation problem because when these guys graduate off, we'll just bring in a new crop of ones who will bring in deposits. It's not really a function of like how successful any one individual program is. It's just an input into this machine that we've constructed. That makes sense to me. I think the other thing that I'm seeing as a sort of counter strategy to this like bundle, unbundle problem is you do see some banks that are in banking as a service take more of a vertically integrated approach where they don't just sign up a fintech company as a partner. They are the first investor in that fintech company. They're on their cap table. They have someone on their board, whatever. And so that makes it much harder to graduate off, right? Like if this program succeeds, our interests are aligned. It's kind of like giving an employee equity in the company, right? Like they're much less likely to leave if they are appropriately incentivized. And you see that with some, I've come across a few fintech programs. I'm like, oh, who's your bank partner? And they're like, oh, it's so-and-so. And they actually led our first round too. That's a different way to sort of solve this graduation problem.
That can come with its own.
As well.
That can come with its own problems, though.
It absolutely can.
As far as like conflicts of interest in how decision make,
Totally.
making decisions that maybe you wouldn't otherwise make actually,
right. No, it does. It absolutely does, and it's not. It rhymes a little bit with Bilt, right? Where it's like another part of the Bilt story that doesn't get talked about as much as it should is Wells Fargo was an investor in Bilt, but probably led them to make some bad decisions. So to your point, like that's not always a good thing. But I do think that, kind of going back to our core thesis, the easy days of like banking as a service, easy button for revenue, I'm just going to push this button and not do anything else, like those days are kind of over, it feels like. And now, if you want to make money in this business, you have to do something like this. You have to vertically integrate and pick the right partners and manage them the right way. You have to build a great lending business where you're taking some risks and doing some things that others might not be comfortable with and funding that with deposits from banking as a service. Like you need a different model, because I think what Trump era regulators have done now over the last year plus is they basically sort of cut the legs out from under the BaaS as an easy button for revenue and growth button that had sort of been built over the last, 5 to 10 years. This episode is brought to you by Persona. Every fintech founder hits the same wall. You need to verify users, but off-the-shelf solutions aren't built for how your product works. Persona is the identity verification platform that puts you in control of your flows, with the automation and scalability to take you from your first 100 users to your first 1 million without replatforming. There's a reason that companies from YC-backed startups to publicly traded fintechs run on Persona. And right now, Fintech Takes listeners can claim a free full year through Persona's startup program at withpersona.com/FTT.
No, absolutely. I mean, I think in the lending use case specifically, a lot of it just feels like basically a toll, right? It's like, well, if you're not a bank, you could go collect, 49 state, whatever the number is, I forget, 49 state licenses that you need to do this.
Yeah, not Montana. That's we don't have such a thing.
Georgia, I think if it's more than $3,000, you don't need a lending license, which is like bizarre.
That's totally bizarre. Anyway,
it's like the opposite of what it should be, but each of those states have like slightly different requirements around loan amounts and permissible APR, and now you're dealing with 49 state exams, and like that's a lot of administrative overhead. Or you can just go, pay a fee to put, I won't name anybody, but XYZ's bank is legally the name on that loan agreement, and they probably retain 5% of the receivable so that they can defend that they're the true lender. And then that bank gets to like collect a fee and maybe, some other servicing revenue or something attached to that. Doesn't feel like particularly a strong value add. I mean, to your point about bank partners becoming more value add or more vertically integrated, I think is the word you use. In the lending space, like you have started to see some of the players in that focus on lending programs specifically start to do things like bring debt capital to the table as well. And so it starts to look more, it's not just, oh, well, we're the name on your loan agreement and we're going to collect a nice fee for that, but like actually then also deploying deposits, deploying capital, to taking fund a portion of those loans, which makes it both more defensible from a regulatory, like true lender type standpoint, as well as more of something that looks more like a true partnership. As I don't tend to use the phrase rent a bank, but as opposed to a rent a bank relationship where the consumer facing lender is paying a fee so that you can put your name on this loan agreement.
Yeah, no, I think that's right. I mean, I think a lot of times about like, how does the environment that you're operating in incentivize you? And I think when the ability to get a bank charter was scarce to slash non-existent, depending on the windows of time you looked at over the last, 8 years, 10, 12 years. Because it was so scarce, it basically created this environment where if you were a bank and had a charter and were comfortable with the sort of like reputational and compliance risk of working with fintech partners, you really could just put up a toll road, collect a toll, and you really didn't have to do anything. And it's like the sea lions that get into the lock, right? They just take a bite of fish and they're like, this is amazing. I don't have to hunt for my food. And I feel like in banking as a service, it's not going to go away, obviously. Like not every fintech company is going to become a bank. Shit, I don't think Chime has any interest in becoming a bank, even at their size and level of sophistication. So it's not going to be universally the case that every fintech company immediately becomes a bank. That's not going to happen. De novo is actually really hard unless you have Peter Thiel giving you just tons of money with no expectation of a return. But I do think that it will require banks that stick in banking as a service. And we saw a number of them kind of back away from the space when the compliance risk started ratcheting up. But I think even more so now because the charters are available, you're going to have to like hunt and kill your own food. Like you're going to have to actually have a value add. You're going to have to actually work hard. You're going to have to actually take and manage some risks. It's not just going to be sort of free money that's sitting there if you want to put up a toll road. And that I think is a pretty meaningful change for banks. And I'll be curious to see to what degree, if at all, it sort of reshapes like the competitive dynamics in the community banking space in particular. Because like, I think, a lot of the community bank stuff was like, yeah, we could do M&A, or especially because regulators aren't really thrilled with M&A either, we could just do banking as a service and just kind of tread water where we are. And I think that era might be ending.
No, I tend to agree. I mean, banks now have to, and I guess this was again always the case to some extent, but banks that play in the space now have to increasingly compete to win business, and competing means having a value add. And maybe 2 or 3 years ago, the value add was, we have a charter. But now it's like, you need to bring some kind of differentiation or expertise or knowledge that makes it attractive to partner with you versus both any other BaaS bank, as well as the option of apparently going to get your complimentary charter.
That's right. That's absolutely right. I just hope that taking more risk doesn't again become a feature of like how you differentiate yourself. We've lived through that in the not too recent past, as you chronicled very well. And I don't really want to go back to BaaS Island, but like that's another way that you can compete is like, we won't ask you too many questions. So hopefully we don't see that. But I to your point, I'm curious to see how like regulators respond to this trend over time. Because I don't think Jonathan Gould at the OCC is thinking that much about how his spree to encourage more de novo formation and to grant more charters is impacting banking as a service. I haven't seen him comment publicly on that at least, but over time, that probably will be something that regulators need to kind of reckon with as well.
Do we have time to get your quick opinion on New York's financial data right bill?
We do.
Quick, because you're the expert. Okay. I will quickly summarize, which the TLDR is basically the state of New York has introduced a bill in both its state assembly and its state senate that functionally would do what the CFPB's 1033 open banking rule did, as well as taking some very important lessons that the CFPB had to learn and the open banking industry had to learn rather painfully. So specifically, in the New York bill's legislative text, it clearly and broadly defines what an authorized representative is, which, as I'm sure you know, became an issue with the CFPB's rule, as well as explicitly prohibiting charging fees in the legislative text. Something that I found interesting, and I'm curious if you have thoughts or a point of view on this, because it's not an area that I'm particularly well-versed in. This is a New York state law. It attempts to cast a very wide net in how it defines what financial institutions would need to comply with it. So it basically is trying to capture any state or OCC chartered bank, regardless of where it is based, if that bank serves a New York consumer, or I should have said this up front, or small business. So this is actually quite an expansion in the sense that it's covering small businesses as well as consumers. The bill also specifies that it would cover any person or entity acting as a custodian for financial assets and any other data provider regulated by the department that maintains a financial product or service for a resident of New York. So I'm curious, like, where you think this lands for different industry stakeholders. What does the CFPB think about this? What does, open banking data aggregators, PlatMX think about this? What does fintech think about this?
So we know that from their early statements that the fintech lobby and the sort of data aggregator lobby think this is fantastic and really like it because it does, as you were saying, enshrine the CFPB-esque principles for open banking as a regulated form in law, if it was to pass, right? This has just been proposed. It hasn't been passed. I'm sure they'll be the subject of a lot of lobbying. But if we assume for a second it passes, it does resolve a lot of things that the CFPB has struggled to resolve, right? The text is very clear about not allowing you to charge fees. It's very clear about what an authorized third party is. It's very expansive, as you said, in terms of this is consumer and small business, not just consumer. This is all state and federally chartered banks everywhere, and also custodians and other. I took that last category as like basically fintech companies that provide financial products to, New York residents, people who live in New York. I think this is going to pose a really interesting challenge because as we've talked about multiple times in multiple different contexts, if you're incumbents in an industry and you're annoyed by federal regulation and you say, you know what, we're going to do what we can to encourage deregulation, or in the case of the CFPB, just the utter destruction of a federal agency, and we'll just sort of like watch it happen and we won't really take any responsibility for the fact that we've just like gotten everyone wound up about this agency for years and years and years. And we're not going to like raise our hand and say, actually, we think the CFPB should exist because it's a good thing to have. If you're, I'll just say banks, and that's been sort of your approach to watching this sort of drama play out at a federal level with consumer financial protection regulation, you are inviting a backlash on a state by state by state level. And Jason, here's my question. So let's say this passes, this becomes a regulation. It applies broadly, right? As you were saying, to anyone who wants to do anything in the state of New York, which is every bank and fintech company in the US wants to serve the citizens of New York. Like, could Chase, and let's just say the CFPB comes out with their updated rule, and the updated rule is you are allowed to charge fees. Can Chase sue the New York DFS over federal preemption for the CFPB's rule saying that you are not, that you are allowed to charge fees, and saying that New York is inappropriately infringing on their right to federal preemption for that? Like, it's weird because I was talking about this with somebody last week. I was at a conference about open banking, so this kind of stuff was coming up a lot. I don't think, unless I'm missing something, that like federal preemption applies as just a blanket principle to everything all the time, right? I mean, as we've seen with Rent-A-Bank and Didmica, as we see with all kinds of different examples, like federal preemption tends to be the result of sort of constitutional questions that then get litigated in court cases that end up acting as precedents for very specific use cases and types of preemption. It doesn't just apply broadly. And so I think it's kind of an open question as to whether the industry, if they didn't want to comply with this New York rule, and I mean, Chase as an example is not going to want to, right? They want to be able to charge fees. Like, what legal recourse do they have to push back on this? Is this a Supreme Court case waiting to happen about a new dimension of federal preemption versus states' rights? That's the thing I don't know the answer to.
And to be clear, neither do I.
Yeah.
But I mean, I think, well, one, I mean, you're absolutely correct that there is not a blanket preemption for nationally chartered banks of any potential state law or state regulation that could impact them. And this has been like a perennial era of like little skirmishes about, states trying to like implement regulations and, OCC chartered banks pushing back. I do think it's interesting that there's a lot of both directly related activities. So we do not need to talk about Didmica. We'll let Kia handle that somewhere else.
She's writing a 14-part series on Didmica. So yeah.
Fundamentally, Didmica also kind of speaks to similar sets of issues as far as parity between state chartered banks and nationally chartered banks, and preemption is sort of interwoven into that. I guess maybe a bit more of a reach, but the emerging set of concerns, to put it mildly, around OCC trust banks and what activities are permissible versus not permissible for an OCC trust bank, which we're seeing sort of incumbents through their trade associations sort of push back on what they perceive to be the expansion of what the OCC may allow these newly chartered trust banks to do. So I think this is just the latest example of, as we see the regulatory pendulum swing faster and more sharply, administration to administration at the federal level, you're seeing sort of that counterweight or counterbalance, at least in certain states, at the state level. And sort of where that intersects, where New York or California, or with the Didmica stuff, I think we're talking about Washington and Colorado, they're trying within the legislative and regulatory sphere that they inhabit, trying to do what they think is appropriate for their citizens, their consumers. But that does intersect with national law and national regulation. And to your point, these things often end up getting hammered out in the courts. I know there was some very, very esoteric case. I want to say it was Contero, about paying interest on mortgage escrow or something, which I like some really boring regulatory court stuff, but even that was too much, and I did not want to read it or go there.
Yeah, no, well, it's the other thing that's interesting about this is that federal versus state tends to be a fight between government agencies, right?
Yes.
So it tends to be a fight between the state of New York and the OCC, as an example. And the OCC, by the way, they are really practiced at going to court to defend federal preemption. They know how to do it. They take it seriously. They want those assessment fees. The state of New York wants those assessment fees. This is a fight that's happened many, many times, and the lawyers on both sides are well acquainted with each other. And the courts know how to sort of interrogate those arguments. But two things about this that are different, right? One is that in a lot of cases, preemption rests on actual laws that have been passed, right? Whether it's Didmica or something else, there are actual statutes and laws that have been passed by Congress that define the limits of different bank charters' powers and different regulatory agencies' powers. To my knowledge, there's really not a lot of laws that define the sort of division between state and federal power when it comes to consumer protection. And it's interesting because if you think about it this way, would the Russ vote CFPB be willing to go to court to argue for the CFPB's federal authority to supersede the state of New York's authority on consumer protection, when really all Russell Vogt is trying to do at the CFPB is to just sort of gut and get rid of all consumer protection? It almost seems philosophically incompatible with the way that Director Vogt thinks about his role in government for him to go to court to defend the powers of the CFPB. I don't even know that would be an argument he would want to make. And to say nothing to the fact that I don't know that argument would work, right? Would the Supreme Court, assuming it reached that far, if it's got, kind of worked out in the courts, would those courts side with the idea that it's the federal government's job to say that states can't protect their, customers, their citizens, and their state? I just don't know that that's going to happen. So the long and short of it is, I think this is a really interesting stab at filling in a gap, clearly that the state of New York feels that does now exist because of what's happened at the CFPB. And I mean, I think it could really, in some senses, break the logjam that we would otherwise see with the CFPB just like putting out a rule, getting sued, putting out a new rule, getting sued. Like that's been the logjam we've had at the federal level. This could kind of potentially unstick it. And I mean, I think it could even potentially result in legislation from Congress to clarify, okay, on this issue, on the issue of like data privacy, data rights, data portability, this is how we want it to work, and this is how we view the split between states and the federal government. I mean, it could end up in that place because I think this pokes at a really hard problem otherwise.
No, absolutely. And I know that you and I love playing amateur lawyers and talking about, the end of the Chevron doctrine and corner post. But it's like, apparently, federal Congress legislators are going to need to become much more expert in the areas that they are trying to regulate, because I mean, need to give Chopra and his CFPB a break because they were drafting a very, very complex rule based on a very short paragraph, frankly, in Dodd-Frank that was passed, 14 or 15 years before they really started to draft that rule. And so, of course, there's going to be a very significant chasm between the words that were put on this page 15 years ago and what actually makes sense to regulate a complex, multi-sided industry where you have, I guess in the language of the bill, like data providers, which we generally think of as banks, but is broader than that, data aggregators, data consumers, which often we'll say fintech, even though that is simplistic, and consumers. And it's like they didn't have a lot of legislative text to work with.
No, one, and the changes that have happened in the world of administrative law means that courts are not supposed to give really any deference to ambiguity that's solved by regulatory agencies. It's supposed to just adhere directly to the text of the law. Now, I will say, having said that, what I've noticed in the CFPB BPI lawsuit over open banking, I believe playing out in court in Kentucky, that judge seems to just be like, look, I don't know anything about any of this. Like, I would just like the CFPB to tell me what they think we should do and we'll just do it. So I don't know that deference will actually go away because judges don't always want to legislate all of this in court cases. But yeah, I think you're absolutely right. And again, going back to the New York proposed law, it's pretty specific, right? I mean, they clearly learned from what happened with the Bureau and with Dodd-Frank. And I mean, they're shooting their shot with this. Like it is by far the most ambitious piece of open banking legislation that's been proposed in the US ever. And I think even if you were to compare it internationally, would stand right up with what they're doing in Canada and what they've done in other countries. So I mean, it's a very forward-looking piece of legislation. And as we know, New York really sort of drives a big wedge in the market, right? I mean, this is not, sometimes you see with these federal preemption states' rights kind of fights, like some tiny little bank or some tiny little state that, banks or fintech companies don't really care that much about. And it's like, Wyoming has decided to do this or Rhode Island has decided to do this. Okay, wake me up when it's a state I care about. But what
about Montana?
Montana doesn't have a MTL license. Who gives a shit? It's Montana. There's 14 people who live there. Don't come to Montana. It's horrible. In all of those cases, it's wake me up. New York, they are the center of this ecosystem in a lot of ways. We didn't talk about the BNPL rules that they are finalizing right now, but that's another example of them sort of stepping in to the gap created by the CFPB. And, to the degree that the BNPL rules apply to different participants in the industry, they're going to have to comply with them because you can't cut New York out of your market. That's just not going to happen. That's not realistic. So I think New York's movements on this stuff is very, very meaningful.
Well, and and we can put a pin in it here, but I mean, it's the latest example of okay, you can push as hard as you want at the federal level, got the CFPB.
Sure.
we don't even need to talk about the CFTC and prediction markets, but I suspect we're seeing something very parallel play out there, where it's like, yeah, there are a lot of other stakeholders who may not like, the outcome you're pushing for and how aggressively and the tactics you're using to do it, and they will push back. And the result, and everyone knows I worked in small dollar. It's like the result may be you end up navigating 50 different state data privacy laws, 50 different personal financial data right laws. And I can tell you, no one in the industry wants to deal with that, because it's worse than whatever the CFPB had cooked up.
Totally. Well, and just to end it there, I had assumed with the CFPB sort of being gutted, the early sort of line on that was, oh, we'll get ready for enforcement activity to ramp up from all these different states. And we've seen that. That's happened. What I didn't anticipate, and I should have, I just didn't think about it, is it's not just enforcement that gets ramped up, it's rulemaking that gets ramped up. And that is a totally different thing, right? Because the thing is, enforcement comes and goes, right? Enforcement, when the CFPB's been gutted and they're not really doing their job, the states ramp up enforcement. The attorney generals in those states are running for other offices, like they're trying to make a name for themselves. But when a new CFPB is there and they sort of take the reins from a consumer protection standpoint, you tend to see that enforcement activity kind of bubble back down, because the states are like, okay, they have it, we'll focus on other things instead. Rulemaking lasts, right? Laws on the books in New York and California and Texas and Illinois, those last, and those will be a pain for the industry for a much longer time. So I didn't anticipate the surge in laws and rulemaking that has resulted from the CFPB stepping back. And I'm not sure that everyone in the industry did either. So that's the thing to watch.
Indeed. Should we wrap it up with what we cannot let go of this month?
I am so excited to hear yours.
Okay. This is timely because it came across my desk today. So the actual underlying video, and this is about the neobank Step, which was recently acquired by YouTuber Mr. Beast. The video or videos in question are actually from 2022, but they have resurfaced because Senator Elizabeth Warren sent a letter to
Speaking of the
Mr.
CFPB.
Beast,
Yeah,
right? Real name Jimmy Donaldson, and the CEO of Beast Industries, Jeff Hausenbold, inquiring about some videos Step had posted to its YouTube and other adverts run on social media, encouraging teenagers and young adults to invest in cryptocurrency. Sorry, this is not funny. One of the videos, and these have since been deleted, which tells you Step is definitely glad that they posted them. One of the videos was basically a coaching manual on how to overcome your parents' objections so that they would let you invest in crypto. So the video was titled, quote, "How to Talk to Your Parents About Investing in Crypto," end quote, which was targeted at kids whose parents want nothing to do with crypto, think they'll end up losing all their money, or simply do not understand it. And it basically provided talking points and answers to common objections that kids might hear from their parents. And one of the lines it suggested using was, quote, "Crypto and stock investing is not taught in my school, but by using Step, it'll teach me life skills like how to balance risk with rewards and self-regulation." And also advised, giving a relatable example, such as, "Mom, you've had Apple stock forever. Bitcoin has just as much potential." Yeah, I don't think it should be surprising that I find this pretty morally bankrupt and disgusting. I'm kind of surprised that it has not come to your or my attention before now, but given that in the screen caps that are in Warren's letter, these videos average about a couple hundred views, I don't think that they were very successful in driving business and revenue for Step. And ultimately, Step wound down its crypto offering in 2024. So resurfacing thanks to Elizabeth Warren. I'm sure that Step, Mr. Beast, and Evolve, Step's big partner, are very glad to have this back out there and circulating. I saw a couple press hits on it already. Which is, I mean, if your motto is about, fostering financial education and like responsible banking, to make videos like that is just disgusting. And I'll leave it there, or I will just like crawl up onto my soapbox. So,
no, I'm glad you did it, because if you hadn't, I would have. I actually had not seen those videos, so I'm glad that Elizabeth Warren and her team surfaced those. I mean, this is the risk I talked about when I started doing the analysis on the Mr. Beast acquisition of Step. Like, it's not really shocking in some ways, because in 2022. If you were a neobank who was struggling to like improve your LTV and like grow as a business, it became a real hard conversation, I think, with your investors to say, yeah, we're not going to add crypto and we're not going to push our customers to crypto. Because at the moment in that time, like adding crypto, investing in as an option and pushing it to your customers was the thing to do. And it was really hard to like be like, oh yeah, no, we're not going to do that. So I'm kind of not surprised. Now, it's particularly disgusting because Step works with like teens, and that's like coach your parents to allow you to take this insane risk. Like, that's not great in any way, shape, or form. But it's a problem Mr. Beast is going to have to wrestle with too, right? Like, I'm glad that's why Elizabeth Warren is surfacing it. She's going to have to wrestle with, or Mr. Beast is going to have to wrestle with, how do we make money as a business without falling temptation to shilling stuff like this. So it's not like this was a funny thing that happened in the past that's horrifying. This is like a thing that Mr. Beast is going to have to deal with right now.
Do you have anything more not crypto related that we can't let go of?
Well, I don't know. Not really. Kind of. Is prediction markets crypto? Are they the same thing now? I think they kind of are, but maybe they're tangentially related. Mine's a prediction market.
The degen economy.
Yes, the degen economy. It's all collapsing in on itself. So this was actually a trending topic on Twitter. Coinbase and Robinhood, but Coinbase more so, shoving like 1,000 ads and notifications down their users' throats every time you looked at your phone. New notification from Coinbase, encouraging them to gamble on March Madness. I'm sorry, no.
You mean invest? In futures contracts?
Invest in futures contracts tied to sporting events that just so happen to be happening in March. Yes, and it was so bad and got so much like trending sort of pushback online that I think Brian Armstrong actually commented on, like, yeah, maybe we overdid it a little bit there. Like, yes, you did overdo it. Another related one, the CEO of Kalshi was running a promotion for March Madness where he was encouraging folks to enter brackets. I don't know how this counts as investing in event contracts if you're like building a bracket, but the promotion was build a bracket, submit it, and if you get a perfect bracket, we'll give you $1 billion. Now, you might remember Warren Buffett backing a similar promotion not that long ago. It's a smart investment from a marketing standpoint because the odds of you winning $1 billion are like impossibly remote. And in his tweet, right before March Madness was about to start, encouraging people to get into it before it was too late, I guess in the CEO's sort of defense, he did say the odds are remote, but he also said the odds are not zero. And he said, this is a generational opportunity to earn wealth, and quote, you owe it to your grandchildren. And I got to say, if you find yourself promoting gambling, and that's what, getting people involved in betting on March Madness, which was the whole point of this promotion, even though the promotion itself didn't cost any money to enter, that's why they were doing this. If you're promoting gambling by saying you owe it to your grandchildren, like, you deserve at some point to end up answering for that in front of a congressional hearing. Like, that is what needs to happen at some point in the future. That is the height of disgusting behavior. And I can't believe there are people who take this person or that company or really this whole industry all that seriously.
I mean, I think a good benchmark, hopefully it doesn't take this long, is some of the recent legal challenges against social media companies like Meta, Google, parent of YouTube, around, in that case, it's specifically, I think, harm to like teenagers around like the product design and some of the use case. Granted, it's taken 10 or 15 years to get those cases to trial in front of a jury. But I mean, the prediction markets are speed running everything. So maybe we'll see a court case on this sooner rather than later.
I will say to your point about speed running, we already have like 3 proposed laws from this Congress, which is not exactly in the business of doing a lot of legislative work, proposing to regulate different aspects of prediction markets, whether it's keeping them out of sports or trying to stop the rampant insider trading and corruption that's sort of popping up around prediction markets. So we're already seeing congressional action that's surprisingly bipartisan too. And so I think Kalshi and Polymarket and Robinhood and Coinbase and everyone who's dipping their toes in this have already bitten off maybe more than they can chew and will regret it. And I hope that regret comes soon, because this is making me lose my shit, honestly.
The real question is, are there prediction markets in whether or not those pieces of legislation will pass?
Now, see, there should be. If these were civilization-scale truth-telling machines that were just objectively trying to help us understand reality, there would be wagers on contracts on both of those questions right in there. Like, when will the CEOs of these companies end up testifying in front of Congress, going to prison before the end of the year? Like, where's that event contract? Like, if you really are objectively just trying to evaluate reality, that should exist too. And I think that's a great point to end on. Jason, thanks for going long. We had a lot of fun, covered a lot of ground. I won't see you in person soon, but we will do this again remotely next month.
Can't wait.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.